The survey projects the economic growth rate to be 6.5% for the next financial year. As of now, the United States economy looks set to avoid a full-fledged formal recession. And therefore, this January already we have seen crude oil prices and industrial metal prices higher than they were at the end of December. From the Indian standpoint, a moderate to somewhat significant global economic slowdown will be on balance a better outcome because it would lead to lower commodity prices and a cessation of interest rate tightening in the developed world, weaker dollar, etc. Therefore, in order to make sure that we fully accommodate the downside risks, the band has been kept at 6 to 6.8 and the baseline number at 6.5%. This number is very much in line with what international organizations have predicted, including what the IMF said this morning.
That was Chief Economic Advisor V. Anantha Nageswaran, who has authored the Economic Survey 2022-23 along with his team. Released on 31st January, the survey asserts that India's recovery from the COVID-19 pandemic has been relatively quick, and it projects that India will grow at a baseline rate of 6.5% and within a range of 6 to 6.8% in FY24. However, it cautions that the global macroeconomic slowdown is the key risk factor to the forecast. Meanwhile, baseline nominal GDP growth is forecast at 11%. The survey says growth in FY24 will be supported by solid domestic demand and a pickup in capital investment. It indicates that incipient signs of a new private sector capital formation cycle are visible, thanks to healthy financials. And the government has raised capital expenditure substantially, compensating for the private sector's caution. However, it warns that while commodity prices have retreated from record highs, they are still above pre-Ukraine conflict levels. And coupled with that, strong domestic demand will raise India's total import bill and have an unfavorable impact on the current account balance. The survey also says that borrowing costs may stay higher for longer, as entrenched inflation may prolong the tightening cycle. Thus, it says that the global economy may be characterized by low growth in FY24. So, will the downside risks overwhelm the upside potential, or will it be the other way around?
I would say that the risks are to the downside, and one needs to remain vigilant at this juncture. There are many positives that India has. The corporate balance sheets are healthy. The banks are in a position to lubricate the economy. Digitalization is helping improve efficiencies. All those things are there. But I think from a short-term perspective, I think the growth risks are high to the forecast of 6.5%, and it's a little optimistic compared to our estimate of 6%, and multilaterals are also closer to 6% right now.
There are fewer downside risks which would materialize, and I think the number which they've given of 6 to 6.8% is almost similar to what we in Bank of Baroda have of 6 to 6.5%. And in the absence of another COVID round or any kind of exacerbation of the crisis in Ukraine, I do not think we have any major downside risk to this number of 6.5% which we're talking of. Given the fact that we know that even the recession in the West is not going to be as severe as what one had anticipated. So whatever external factors are there which could be having an impact on domestic growth, that would tend to be tempered to a large extent.
The RBI has projected CPI inflation for Q1 FY24 at 5% and for Q2 FY24 at 5.4%. Against this backdrop, the survey says that upside risks to India's projected benign rates may outweigh the downside. It still says that the inflation challenge in FY24 will be a lot less stiff than it was in FY23. In conclusion, it expects both the monetary and fiscal authorities to be as proactive and vigilant as they were in FY23. So, how do experts read this expectation?
The drivers of inflation are not fully dead as yet, so to say. So I think you'll need to be cautious on the inflation front and possibly the imported inflation part. Although I expect the rate cycle to end after another rate hike in the month of February. From a fiscal perspective, I think there is no doubt about it. I think the survey is batting for fiscal consolidation in a way. I think it is talking about reducing the deficit. and the positive spillover benefits that it has for interest rates and other things in the economy. So I would say that the fiscal consolidation and monetary vigilance, I think both these are the two signals that I get from the survey.
Inflation is going to be moving in a downward direction. That is a given fact from the economic survey. On the other hand, it also talks in terms of monetary caution, in the sense that it sort of signals saying that as far as monetary policy is concerned, let's not really expect that the RBI is going to start lowering the interest rates immediately. It will be a very cautious kind of an approach which will be followed by the RBI, even though inflation is going down, and this sort of gels with what the RBI has also maintained. As long as RBI retains the repo rate, let's assume it goes up to 6.5% and remains at 6.5% for a prolonged period of time, the cost of borrowing will also continue to remain where it is right now. So while it may not be going up further, but the possibility of lending rates coming down will not be in a hurry.
And finally, what are the survey's implications for the union budget that will be presented on the 1st of February?
I think one signal on the fiscal consolidation will be adhered to, and I think my sense is government will facilitate further private investments, and also I think keep the pedal on infrastructure investments. The growth is slowing, so the tax revenues will not be that buoyant. So they'll have to reduce revenue spending and increase and shift it towards capital spending. Now, this was the strategy last year also, but this strategy did not succeed because the subsidy bill actually went up higher than what was expected. Now, in the coming year, I think the chances of global price hikes of the kind that we saw last year are less. So I would say that the support to expenditure restructuring from the external environment will be much higher this year than it was last year.
See, what I think the only takeaway for the budget would actually be the GDP growth number. So here it has been projected in nominal terms to grow at 11%. There were quite a few economists as well as analysts who felt that given the fact that inflation has come down, the nominal GDP growth for next year would be less than 10%. So our sense is that it would be in the region of 11 to 12%. The economic survey is talking of 11%. And I think it would definitely be above 10%, but that would give that much of elbow room to the government when it's deciding on the fiscal deficit ratio.
The survey has painted a conservative growth outlook while emphasizing that India's economic fundamentals remain strong. Now, all the attention will shift to the union budget to see whether it will be able to secure the country's growth against the downside risks highlighted by the survey, while at the same time making the most of the upside potential highlighted by it.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.